Hey there, Brad Casser from GreatOptionTradingStrategies.com. Okay, so I wanted to do a quick follow-up today to my last video where we looked at a recent put-selling trade on Boston Scientific that we did inside the Leverage Investing Club, and where we chose, based on some pretty basic technical analysis, to exit the trade one day early and essentially leave half our max potential gains on the table. Ouch, right? We're not really accustomed to doing that. Typically, when we exit a trade early, it's because the annualized rate of the money we're leaving on the table is accruing at such a low rate that it no longer makes sense to keep the position open. But if there's something involved in the technicals that we see as a potential red flag, we'll go ahead and close things down early, which is exactly what happened with the Boston Scientific trade. And it turns out, in hindsight, it was totally the right move. So I want to do a follow-up video today, but not just to pat myself on the back. I want to do a follow-up video because the trade illustrates a subtle but very important risk for anyone who trades the wheel strategy. Before we get into that, I just want to quickly tell you about a number of free resources I have over on the Great Option Trading Strategies downloadable library page. I've got quite a few ebooks, special reports, and strategy guides available over there. And depending on where you are in your option trading journey or your personal finance journey, you should be able to find some resources that matter to you. And you can find a link to those resources in the description section. Two of the most popular downloads are Trading for a Living, My 4 Rules, and Options Are Easy. Stop stressing and learn what options can do for you. Trading for a Living is perfect if you're in retirement, nearing retirement, planning for retirement, or even wondering if early retirement is for you. And if you're new or relatively new to options, you really need a quick and easy guide to the nuts and bolts of option trading. So you're definitely going to want to check this one out. Options are important risk management and return enhancing tools that every self-directed trader and investor, yes, investor, needs to understand and be able to use. And this user-friendly 10-page guide will have you up to speed in just minutes. Okay, let's jump in. Now, I've made no secret that I'm not a fan of the somewhat popular beginner option selling strategy, the wheel. If you're unfamiliar, the wheel is a very mechanical strategy where you keep flip-flopping back and forth between short puts and covered calls. For example, you sell puts on a stock until the puts get assigned because the stock sells off. Then you sell covered calls until your shares get called away because the stock spikes or recovers or trades higher. Then just rinse and repeat. Now, I do see a couple of positives with the strategy. One is that it introduces the power of generating income from selling options. And number two, it gives its practitioners valuable nuts and bolts experience with the structure of selling both cash secured puts and covered calls. But at the end of the day, it really is a terribly inefficient strategy that disregards some of the most important elements of an option selling trade, including identifying and waiting for a high quality trade entry, strike price discipline, and timing trade management decisions. The wheel gives Mr. Market way too much control over a trade by waiting for him to dictate the timing of trade moves. Now, I actually have even more concerns than that, but today's video isn't about a deep dive critique of the wheel or just piling on to pile on. Instead, I'd much rather just take a few minutes to drill down on one subtle but very real risk with the wheel that a recent Boston Scientific trade really underscores. And that's that the bias or impulse or unwritten assumption with the wheel is for every trade to turn into a campaign. So not much thought, if any, is given to actually exiting a trade. And if you really think about it, that's a risky way to approach a trade because it's probably just a matter of time before something goes wrong. Eventually, the underlying stock will make a big move, and that's not a good thing if your plan is to keep the campaign going indefinitely. If the stock blasts higher and you don't walk away, the wheel will basically have you chase the stock higher. Now, that can work nicely in a stock in a nice, steady, orderly uptrend, but if the stock makes a big move higher and you feel forced to chase it only to see the stock give back those gains, that's a recipe for getting whipsawed. But the bigger risk is if or when the stock sells off, because now you're going to be underwater on the trade. And it doesn't matter if you're selling covered calls or if you're selling cash secured puts. That's also something else that most practitioners of the wheel don't fully understand. Selling naked puts and writing covered calls are two different ways to structure the same trade. Now, if this is news to you, I have a deep dive video that demonstrates how short puts and covered calls are 98% the same trade, which I've linked to below. Okay, with that as an introduction, let's look at how the wheel would have crashed our successful Boston Scientific trade. So in my last video, I shared the details of a somewhat disappointed but still profitably exited put selling trade on Boston Scientific. It was disappointing because, again, due to some technical warning signs, we decided to exit early with just half our max potential profits. We sold puts for 80 cents a contract and then bought them back one day ahead of expiration for 40 cents a contract. The original terms of the trade had been 24.19% annualized returns projected over 17 days until expiration. But we left enough money on the table that we walked away with a scaled back 12.63% annualized ROI over 16 days. Now, this was not a terrible trade, but as I explained last time, we're definitely not in the business of refunding Mr. Market half his premium like that. Now, if you want the full story, I've linked to the Boston Scientific case study video from last time, when to accept partial profits on cash secured puts. And you can find that in the description section. Now, I also want to point out it would not have been the end of the world to keep the trade going, even if the stock continued drifting lower and we needed to manage it, massage it, and eventually repair it. But my point is, why take that risk when the technicals were already flashing a warning sign? And that warning sign, as you can see in this chart, was that after dipping below our $70 strike price for a few days, stock rebounded some, recaptured the $70 share price level, but then for 3 days running, it kept getting pushed back from that $71.50 to $72 area. So it was not a huge shock then when the stock did pull back some the next day and closed below the $70 share price level at expiration. So if we'd stayed in the trade, we would have had to roll or adjust and work on repairing the trade. Now here's the important thing. Fast forward to Monday, March 30th, or just 6 trading sessions after that March 20th monthly expiration date. Raymond James downgrades the stock, which was kind of a weird downgrade from strong buy to outperform. But it was enough to tank the stock, and Boston Scientific closed 10% lower that day. But because we had trade management discipline and respected the technicals, we were out of the trade and there was zero impact to us. Now, if we'd been wheeling Boston Scientific instead, it would have been a very different story. And it doesn't matter whether we had $70 short puts or $70 covered calls. We'd be equally underwater on the trade. Now, I want to be clear. I'm not saying that the technicals predicted or anticipated the downgrade and gap lower. Technical analysis at its best doesn't tell you what will happen, like having a working crystal ball. But it does tell you what's more likely to happen and what's less likely to happen in the near term. Case in point, if a stock can't push through resistance, well, simple deductive reasoning tells you that there's an increased chance in the near term that the stock is vulnerable to a move lower, which is exactly what happened. But the larger point I'm making here is that there's a very real risk to keeping an option selling trade going just to keep it going, especially if you see some kind of technical warning sign. At the end of the day, that's just asking for trouble. Inside the Leveraged Investing Club, 99% of the time, the only reason we keep a trade going is to repair it. Our first choice is always to be in and out of a position safely and profitably, and then move on to the next best opportunity we see. And by best opportunity, I mean a high quality trade setup and entry where the technicals are flashing a green light, not a red light. So in my view and experience, you're so much better off entering high quality trades and then exiting them at optimum times. That means exiting a winning trade when you can lock in the bulk of your max potential gains when what's left on the table is only accruing at a low annualized rate. Or it means exiting a winning trade when the technicals are flashing some kind of warning sign, like they were doing with the Boston Scientific trade. In the first instance, you should be able to find better paying trades at that point. And in the second instance, you avoid potential headaches. Case in point, Boston Scientific shareholders and anyone wheeling the stock is dealing with a headache now, but not us. We're back on the sidelines and now watching it for a more favorable re-entry. Okay, if you enjoyed this and want more option selling resources, be sure to check out the channel's other videos and playlists and subscribe. And I've got a backlog of other videos in the works. Also, sign up for the Daily Tips newsletter via the pinned comment below. The newsletter is a tremendous option selling resource and really complements the YouTube channel, as some topics are better suited in article format and some are better suited in video format. Both resources are about heads you win, tails Mr. Market loses. So the newsletter is a resource you're going to want. You can sign up directly, or there's a link in the description section below to the Great Option Trading Strategies downloadable library page that I already told you about. Download anything from there and you'll also begin receiving the Daily Tips newsletter automatically. Heads we win, tails Mr. Market loses. Let me help you come out ahead on virtually all of your trades. Okay, until next time.